In the first week of April 2025, the S&P 500 lost more value than in any week since the COVID crash. The headlines came fast, your portfolio went with it, and at some point in the last few weeks, you thought about moving to cash. So did millions of other people. That move is the mistake, not because the fear is wrong, because the math of what happens next is almost always the same, and you need to see it before you make the move. This video is about what that math actually says. If you've been watching your portfolio drop for weeks, this is for you. If you've already moved to cash and are wondering when to get back in, this is especially for you. The fear you feel right now is the correct response to real information. Markets are down. Tariffs are unpredictable. Recession risk is real. And the advice you've been given, don't panic, feels like cheerleading. It is not an explanation. It is just a command. Nobody showed you why. Nobody gave you the actual number. This video gives you the number. And once you see it, the decision becomes much clearer. Here is the reframe. Over any 20-year period in modern history, the stock market has gone up, but within that 20 years, 10 specific days account for a disproportionate share of all the gains. JP Morgan's market data, $10,000 invested and left alone over 20 years. It becomes nearly $30,000. Miss just those 10 best days over 20 years, and that same money only reaches 14,000. 10 days, half your returns, gone. And here is the part that makes this so dangerous. 7 of the 10 best market days in that 20-year period occurred within 2 weeks of the 10 worst days. The crash and the recovery are almost always neighbors on the calendar. If you are in cash on the bad days, you are almost certainly in cash on the recovery days too. That is the most expensive mistake of the year. Let's look at the evidence. JP Morgan's guide to the markets tracks this data going back decades. The returns collapse rapidly with each missed day. Missing 20 days takes you to 8,500. Miss 30 days, and you actually lose money over 20 years. 30 days out of a 7,300-day period. That is less than 0.5% of all trading sessions. The Dalbar study tracks what average investors actually earn versus what the market earns. The average equity investor earns 3.7% per year. The S&P 500 averages 11.9%. That gap, compounded over 20 years, represents hundreds of thousands of dollars. The cause is not bad stock picks. It is getting in and out at the wrong times. Let me show you the clearest example in recent history. In February and March of 2020, the S&P 500 fell 34% in 5 weeks. That is a third of everything gone in 5 weeks. Millions of investors sold at or near the bottom. March 23rd, 2020 was the market bottom. From that bottom, the market gained 68%. In the next 5 months, anyone who sold and stayed in cash watched that 68% happen without them. Most of them re-entered months later, after the gains were already priced in. The gap between the two investors, same starting point, same market. That gap is the cost of the exit. The same pattern played out in 2008 and 2009. The S&P fell 57% in the 2008 crash, then recovered more than 400% over the next decade. Investors who stayed in versus investors who got out. The decade-long difference is enormous, and yet people keep making the same move. Every single market crash, every crash, same pattern, same mistake. The reason is in the brain. Research from psychologists Amos Tversky and Daniel Kahneman, work that won Kahneman the Nobel Prize in 2002, identified something called loss aversion. Losses feel twice as painful as equivalent gains feel good. Losing $100 hurts twice as much as gaining $100 feels good. So when the market drops 5%, the pain signal is enormous, and the rational signal, the data says to stay, feels much quieter than the fear, which is why selling during crashes feels rational, and why it is almost always wrong. Understanding loss aversion doesn't eliminate the fear, but it changes what you do with it. When you feel the urge to sell, you are feeling loss aversion, not insight. And loss aversion creates a second problem, the waiting to get back in trap. You sell, you feel better. You wait for the right moment to get back in, but the right moment never feels right, because every time you think about going back in, The same fear signifiers. Investors who sold in March 2020 waited an average of 10 months to re-enter. The market nearly doubled in that window. They sold low. They bought back in high. The move that felt like protection was actually the most expensive sequence they could have made. So, what do you actually do with this? The first thing is the hardest, and it has nothing to do with the market. Stop checking your balance. Every time you check the balance during a crash, you are giving your loss aversion a live feed. You are training your brain to feel worse. Don't watch the balance. Watch the allocation. The question that matters is not how much have I lost. It is my allocation still right for my life? If your allocation is right, the correct action is nothing. Doing nothing is a decision, and right now, it may be the most valuable one. But if you feel you must do something, there is one productive action: rebalance. Rebalancing means selling what went up and buying what went down. You are buying the market at a discount. Then it recovers, and your portfolio recovers faster. It is the same nervous energy, redirected toward the correct action. There is one more number worth tracking during volatile markets: the VIX, the market's fear index. When it spikes above 30 and then begins falling, sentiment is stabilizing. A declining VIX doesn't guarantee a recovery, but it means the panic is easing. And keep asking, have the economic fundamentals actually changed, or just the mood? Markets price in fear before the data confirms it, and often before the data justifies it. So here is what you actually have. 3 things. Stop watching the balance. Check the allocation. Rebalance if needed. That is it. That is the entire active protocol for a market crash. Not panic, not heroics, just a protocol. The investor who followed the protocol and the investor who panicked. In 5 years, they look very different. Right now, millions of people are at that decision point. You are watching this video instead. That is already the difference. The market will keep moving. Some days it will feel like the end. Most of those days won't be. The most expensive mistake of the year is one you can simply choose not to make. If this is the first time anyone gave you the actual number, subscribe. The next video goes deeper into exactly how to rebalance when a market is falling and when not to.